and welcome to the NRP Daily right here on the National Real Estate Post on another Saturday with Barry. How you doing, Barry?
I'm doing great, man. I'm really looking forward to chatting with you.
Yeah, let's talk about stuff. It's been a while. Some things had happened, personally for me, etc. So we kind of missed a couple of beats there, but we're back on track. So let's talk about, like last week, what went down, and then what you see happening this week, with respect to, rates, of course, housing data, that kind of a thing. What's the scoop?
So a couple of things to note. Number one, with respect to interest rates, look, interest rates are so awesome, and a lot of people are feeling that rates are going to just stay here forever. What I'm here to say is that I think there is reason to believe that rates may drop a little bit, but capacity right now being so high will probably keep rates above what their natural level would be. Now, there might be a few times where you're going to see a bit of a blip higher on some spikes. You might see it on, God willing, hopefully good news with regards to defeating the virus via vaccine or therapeutic treatment. So we have to be on guard for that. And it's important to tell our customers who think that, hey, look, I could just wait this thing out and be in great shape. That isn't guaranteed. I do believe that there's good reason to think that treasury yields will go lower. I think the 10-year treasury tests 50 basis points, maybe goes to 40 basis points, and the 30-year treasury bond right now at about 130. I think it breaks 1%. I think in fact it gravitates towards 70 or 80 basis points.
Wow.
Which it's a big move. But here's the thing, we've been accustomed to, pretty much all of us through our careers, that while the 10-year treasury and mortgage bonds, 30-year bond as well, directionally they tend to move similarly, but not always in lockstep. And people mistakenly say, oh, there's a spread that's consistent between the 10-year treasury and mortgage rates. That is not the truth, okay? That spread fluctuates, and where we are in the market today versus where we were just a few months ago is a prime example of that. So you can't go by that relationship. And there comes a point in time that could be shocking. See, one of the things we have to watch is the unemployment rate. Now, that's the next thing I want to talk with you about.
Okay.
Is if this remains persistently high, it will creep into somebody's ability to purchase a home. And I'll give you all the reasons why in just a minute. And that could cause not just purchase issues, but more importantly, paying the mortgage issues. And that could create a premium to interest rates on mortgages. Now, let's think about this. Treasuries are considered a risk-free interest rate because they're backed by the full faith and credit of the US government. So listen, maybe some people might be a bit skeptical of that, but that's
right.
Generally accepted, okay?
Right. Mm-hmm.
Mortgages are dependent on a borrower making a payment, so there is some risk. Now, there's high incentives that they'll pay it, but it's also correlated towards those people having a job, and we know what's going on. So we know there's some things like forbearance right now. We know there are things that are out there like PPP and PUA, Pandemic Unemployment Assistance. It's very widespread, Frank. This is pretty shocking. So we're trying to gauge how many people are unemployed. And if you listen to the Bureau of Labor Statistics, the BLS, they told us a couple of weeks ago that the unemployment rate's 11.1%. We had a hard time kind of digesting that and thinking that that was true. Now, the BLS themselves said, well, wait a minute, there's some misclassifications, so it's really 12.1. So they themselves admitted there's some issues, but you really have to dig deep because this is not something that people talk about. But what I mentioned earlier, this pandemic unemployment assistance, it's very meaningful. Do you know that right now, 32 million Americans are receiving some sort of unemployment assistance. The labor force is 160 million. So that means 20% of people are receiving some sort of assistance. This is big because what may happen here are three things. One, PPP is going to begin winding down for many companies that received it. So how do they handle things? Because we know that we are not necessarily opening everything up in great shape, right? So what happens if you have no PPP and business isn't there to those employees? Number two, you have this pandemic unemployment assistance, and this is where you get some supplemental help as well. Do you know that just last Thursday was reported that 1 million people on top of the 1.3 million that filed for unemployment benefits for the first time, filed for this for the first time. So people are seeing, they say, oh, well, things are getting better because I see that, the initial jobless claims are going down. Well, first of all, even at 1.3 million, it's 7 times what we're accustomed to. And this is brand new. So if we're supposed to be opening up and things are great, why are 7 times what we're accustomed to filing just last week for unemployment benefits,
Mm-hmm.
first time in losing their job. So there's still something going on there. But it's not just that number, Frank. There's a million people on top of that. And when you take a look at something called continuing claims, people still receiving assistance, yes, it hits some pretty big numbers. And yes, it's come down a little, but there's still 17 million people, according to what the Bureau of Labor Statistics is telling us. And then wait a minute, there's another 14 million people getting this pandemic unemployment assistance. The point being is that we could be, over the next couple of months, in a position where we start to see some issues with people being able to pay their mortgage. And if it becomes persistent and if it becomes widespread, believe it or not, you could see treasury yields go down, but you could see mortgage rates potentially bump up a little bit. It's just, we have to see how it plays out. What if the government comes out and they say, look, we'll assist with more, we'll extend this. They may be able to rectify it. In the backdrop of this, at the end of August, 20% of people who are renting will be eligible to be evicted. 20%. Just think about how many people are renting, okay? 100 million people or so renting. 20% of them could be evicted. Now, we know they're not going to be evicted. We know that there's going to be some horse trading. They're going to buy some time. Maybe they come up with some money. And certainly the landlords aren't going to be able to evict everybody, and there's a process. I'm saying eligible for eviction, and what actually happens is a different story. But one other aspect of that is even those landlords that were depending on that income who aren't getting it, they have their own set of problems too.
Right.
This is not as rosy as, seeing the stock market behave the way it is, and some of the people that come on TV and saying, oh, how things are really improving and great. Not as rosy. There are some things that I'm concerned about, and it could have an impact on us in a different way than we're accustomed to. We're accustomed to bad news, interest rates go down. We're accustomed to treasury yields go down, mortgage rates go down. We're accustomed to these things. But while it may not happen, we need to be smart enough and nimble enough to know that we can't depend on those previous relationships, and we need to know what to look for, because if that relationship gets broken, we don't get blindsided, our customers don't get blindsided, our purchase deals don't start to become in jeopardy, and that we maximize what we could do in advance. It's probably a good message to talk to your customers about and get them off the fence.
Wow. That's a lot to consider. And you're right. I mean, that's not what's out there in the mainstream media right now at all. So timing wise, I mean, what's your thoughts on that? Is this like, if what you're saying is indeed the way that things are going to go, I mean, what is this, like 4 months or something like that, where you really start to see the effect of this? Or
it may be slightly sooner than that. It's very difficult to gauge because we don't know what the government's going to do. We don't know if the government comes up with another program, if there's another way to help or bail out. It could be humanitarian, but then there's a cost for these things, because it does create more debt, which does slow our ability to have a robust economy. So this is a very difficult situation. I mean, obviously the best thing that can happen is, and there's a lot of promise out there of different vaccines, and there's a lot of promise of therapeutics. But if we can really get our arms around and corral this virus, let's just, God willing, say by this time next year, really get a good handle around it. And you have good testing, you have a good vaccine that's starting to be distributed, you have a good therapeutic to continue to decrease the rate of deaths and shorten the duration of the virus so it's not as scary. If that's the case, then this period of time, which will be rocky, should be looked at as an opportunity. Because if that starts to happen towards the end of next year, well, you'll have a natural move that's be a little bit higher in interest rates, because you'll start to see treasuries improve, and mortgage rates won't go up as much, because once again, the capacity premium.
Right. And it's kind of already there, right? Well, you've been kind of indicating this for the past several shows that we've done together, that something like this is kind of brewing behind the scenes, and that we should be kind of cautious and watching out for it. So you're staying true still to this thought process right now, and so we'll just do that. I mean, we'll just keep our eye on it and make sure we're not overly excited, about the real estate market, et cetera, because things could change, pretty quickly here. What about this coming week? What like in our immediate future, this week coming up, what indicators are popping up that might have an impact on our rates?
You're going to get good housing data this week for sure, like we have been getting. So it's going to be very encouraging. Look, the new construction side's coming back, with the existing home sides coming back. People are oftentimes in a position where you have to win the home instead of buy the home because
Right.
there are multiple offers. I believe the most recent statistics show that 55% of purchases had multiple bids on them. And I think it's probably going to be greater than that when you contemplate that that data is a little bit older and the market's actually now see more people enter that market with inventory very tight. So you really have to come in well prepared. You have to know that, is it worth it for me to bid over asking price? You know, that's a big consideration. We don't want to pay more, but let's be cognizant of levels of appreciation. Let's be cognizant of where we will be in the future so we can tell that customer how long it will take you to recover the amount that you're bidding over asking price. I mean, you want to win the home, you want to get the home, we know it's tough to get it. In the long run, it'll be great. But are you talking about bidding over asking price on this particular home and it'll take you 3 months to recover that, 6 months, or 3 or 4 years? Totally different mentality on those, because if it's going to be that long, do you really want to fork out that kind of money way in advance? Maybe you should just keep shopping and keep looking at something else. And if it's a little bit over that, you'll recover that money back within 6 months. Probably that I could say, hey, let's live with that, win the home. But if it really would take an amount of years to recover that money, you may be putting yourself at undue risk and really cheating from your own future.
Yeah, I was just reading an article off of our site from the M Report saying that that inventory is 32% lower year over year right now. So just kind of adding to that, compounding that problem, you know. So
what's interesting though is that, unfortunately, if this situation persists and puts strain on families that can't make their payments and they are past the forbearance period and they now have to make a decision, or they weren't eligible for forbearance, then what you may start to see happening is people putting their homes on the market to increase inventory. Fortunately, inventory is so light that it won't have an adverse effect on the real estate market, but you won't see fire sales. And the reason for that is because their homes will go quickly if they're priced correctly.
right.
Will have equity in their homes. And
Mhm.
people won't, it's not 2010, here's my keys because I'm so upside down.
Right.
20% of homes are upside down then. Today, 2% are.
Right.
And the vast majority of people have so much equity, they'll be incented to protect it, whether they borrow the money to pay their mortgage eventually and not have foreclosure, or sell the home and preserve their equity. So people will respond differently. I think the housing market is in a position to withstand some forces against it, especially if it's temporary. If it's for the next year and we come out of this thing, we start to see improvement, boy, any dip that you could find in home prices in your marketplace probably should be viewed as a buying opportunity.
Good enough. All right, Barry Habib, thanks so much, man, for spreading some knowledge, dropping some knowledge on everybody here this fine Saturday, and looking forward to talking to you again next week.
You bet, brother. And hope you all have a great week ahead. We'll see you next week.
All right, you guys have a great one. Do us a favor, leave us your comments down below, forward, share, and subscribe, and we'll catch you here next time on the NREP Daily on the National Real Estate Post. Adios.